Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays.
Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Good morning, all. Welcome back for another Wealth Coffee Chat. I'm Daniel McPherson from Positive Tax. All right, so today we're going to talk about something that's going to hit every business owner in Australia, and it's going to hit pretty hard if you're not ready. And we're talking about Payday Super. So the legislation is done. It's been passed. It went through Parliament 4th of November. It got royal assent on the 6th, and it kicks in from 1 July 2026. So we've got a bit of a runway, but it's a lot shorter than what people think. So let's talk about what this means, what's changing, and in my opinion, the government really shouldn't have they should have put a legislation grace period in, because this has only been just set up, and a lot of businesses are going to get caught out with this. So let's start with where we're at today. So right now, as it stands, employers calculate super every time someone gets paid, but they only have to pay it quarterly, and they've got 28 days after the end of each quarter to pay that money into the employee super fund. So if you pay your staff weekly, you're still only having to pay super 4 times a year, and that basically creates like a 3 to 4 month cash flow buffer for the business. Now, super only becomes tax deductible when paid, which is why a lot of businesses pay their June quarter super on the 28th or just before the end of 30 June, so they get the deduction for that financial year. So perfectly legitimate under the current rules. But if you miss that quarterly deadline, you get hit with a super guarantee charge, which they call SGC, which is fairly harsh. So you pay 10% interest. You have now the old $20 admin fee per employee, and your late super becomes non-deductible. So that's kind of the regime that we've known for decades, and has been in place. But however, this new legislation, or Payday Super, from 1 July 2026, flips this all. So under the new laws, super now has to be received by the funds, so not just passed and not just processed, but actually received by the fund within 7 days of payday. So if you pay someone on the Thursday, their super has to land in their super fund within 7 business days. So if you're normally a weekly payroll, you've now got weekly super. If it's fortnightly, you've got fortnightly super. And if it's monthly, you've got monthly super. So that kind of quarterly buffer that a lot of people rely on is now gone and is no more. And I guess the key here is the ATO now sees everything instantly. So with Single Touch Payroll, it tells them what wages you ran, what super you owe, and the clearinghouse tells them also exactly what's been paid. So if these two don't match, the ATO kind of knows now in real time, so it's real-time compliance. There's no waiting until the end of the quarter, and there's no sort of hoping that no one notices. Now, this also changes year-end tax planning a bit, so we won't be able to prepay the June super early to get the deduction because we'll be paying it throughout the year, and you won't be able to delay super until cash flow improves. So super timing is now tied to the payroll cycle, and there's no exceptions to it at all. So I guess now let's talk penalties because the legislation that was passed kind of rewrote the penalty system. So if you're late paying super after 1 July, you still get hit with super guarantee charge, but the formula is different. It's now the super shortfall. So there's plus notional earnings. So I guess effectively earnings that the employee would have earned on the if it was in their fund, plus a 60% administration uplift, plus any choice of fund loading if you didn't follow the choice rules. So instead of the old $20 fee, you now get a 60% uplift, and this is going to add up very, very, very quickly. So the interesting thing about this one, though, is that SGC will now be taxed on from 2026. In the old system, it wasn't. I guess it doesn't make it any more pleasant. It's still expensive, but at least it's not an after-tax payment anymore. But on top of this super guarantee charge, there's also a brand new penalty for not paying the super guarantee charge itself. So if the ATO issues you a notice requiring you to pay the SGC and you don't pay it within the 28 days, you get hit with another penalty, 25% of the unpaid amount, or 50% if you had unpaid super guarantee charge in the last 24 months. So this replaces what they used to call the old 200% penalty. And yes, directors can still get direct penalty notice for unpaid super, so that hasn't gone anywhere. And GIC interest still accrues on top of everything as well. Now, let's talk about what most people have been saying is the big elephant in the room, and that's the leniency period. You may have seen the ATO say we'll take an education first approach in the first 12 months. And yes, that's what they have in their draft compliance guide. But this is really important. This grace period or this practical education first isn't legislated. So there's no safe harbour in law, there's no statutory grace period, there's no penalty-free window, and there's no transition buffer. So the law says if the super's not received within the time frame, you have a shortfall, and super guarantee charges apply. Full stop. So the ATO might be saying that they're going to be gentle at the start, and maybe they will, but it's an administrative choice, and it's not really something you can rely on. And honestly, I think this is where the government have dropped the ball in passing this legislation. I think there should have been really a genuine introductory period, whether that sort of be sort of 6 months or something, but it's going to be a huge operational change, especially for small businesses. And instead, they've left businesses with the full penalty regime from day one and a bit of a verb, don't worry, we'll be nice. So that's not really a risk management from my perspective. But I guess what does that all mean in practical terms? So the payroll frequency suddenly becomes a cash flow decision. If you're paying weekly, you're now paying super weekly. So that's going to, I guess, interrupt cash flow for a lot of industries. I expect many businesses will move from weekly to fortnightly or even monthly payroll to reduce super frequency. I guess there's also been a few things go through Fair Work that may also necessitate a need to go to a longer payroll period. And then the next thing is automation is really non-negotiable now. So they're forcing everyone onto a payroll system. There's no more handwritten spreadsheets, timesheets, someone doing admin manually. That's not going to cut it under this. So systems like Xero, MyOb, Employment Hero, KeyPay are going to be essential. And automation isn't being upgraded anymore. It's a necessity. And the ATO also closing their super clearinghouse. So really, as far as we're concerned, there's no real free way to pay your super clearinghouse anymore. They're forcing it through one of these other providers. It's going to mean that, so from a, I guess, cash flow perspective, you're going to have to be on top of it a bit more, keeping those funds separate. It's going to come out more regularly, so I guess that somewhat be a little bit easier knowing when the rhythms are and when it's coming out. And one of the other big things is you need to fix historic payrolls before this 1 July 2026 hits. So Payday Super will expose every mistake straight away. So that includes like wrong award classifications, underpaid, overtime, casual loadings not handled correctly, incorrect actual super calculations in themselves. So the system sort of has a little bit of breathing room up until then, but you do need to get it sorted and do a bit of an audit on your payroll. Now, I guess if we flip the lever for a second and look at it from the employee's perspective, I mean, overall, it's probably a pretty sensible decision to have Payday Super. So instead of getting the super quarterly, they're now getting it with their pay more frequent, which means better compounding. So the money hitting your super weekly or monthly makes a huge difference over your working life. And really, when you look at compounding, this could be like tens or even hundreds of thousands of dollars more at retirement. So it also massively reduces the risk of underpaid super. So dodgy employers relying on the delays to hide sort of non-payment, they're going to get caught out more quickly. So it gives the employees a bit better protection as well. And the transparency significantly improves. So your contributions will show up in MyGov much more consistently with your pay. And this will be easier to look at potentially making sure you don't breach your contribution caps at the end of the year. So win for employees. The system definitely built for employees, employee protection, but particularly at the moment for employers, especially small ones, they're going to really, really feel the shift and make sure that they're on top of this so they don't get caught out. So I guess a bit of an action plan for those business owners. Review your payroll frequency. Need to get that system in place to automate your payment and super payment. Set up a wages potentially super bank account. Move to weekly or fortnightly cash flow forecasting. Make sure your awards and your payroll set up correctly now rather than waiting until July next year. And make sure that you're not caught out with any of these penalties. All right, team. So that's Payday Super. Legislation has now been passed starting July next year. Some fairly decent operational changes that a few people have to put in place, and no grace period, unfortunately. So get in early. It will be manageable, but don't leave it to the last minute. All right, guys. That's it from me today. Hope you have a great day. See you next time.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.